Hi, this is Alan Gassman, and I'm here to present mathematical planning with EstateView software. It is Saturday, August 10th, 11 a.m. We have about 50 participants, and I welcome you. I'm looking forward to this presentation. I hope you enjoy it. You can go to the questions panel over here. I thought I had a picture of the questions panel. Sorry, I guess I don't. But you can go to the questions panel and you can click on the upside down pyramid and type in your question, and I will be sure to answer it during the presentation or after the presentation. I forgot the puppet. I'm really sorry. You should be sorry. Don't forget the puppet next time. Okay, I just didn't have anything scripted out for you. Oh, okay. Bye-bye. All right, so you got the puppet. Today, I'm going to show off EstateView software, and I'm going to talk about 2026 and pre-2026 planning and anything else you would like to hear about. Before I do, please join us, cyber or in person, at the 50th Notre Dame, or is it 51st, Notre Dame Tax Institute. In any event, it will be September 25th through September 27th, 2024. And my partner, Brandon Ketchrin, along with Brad Dillon, a very, very bright tax lawyer from New York City, will be, sorry, I'm looking for my cursor here, will be handling a lot of estate planning calculations and estate tax planning calculations. Also, Marty Shinkman will talk on avoiding mistakes in trust administration. And if you see Thursday and Friday, you notice how many really nice presentations there are. I'm going to be talking on creative planning for charitable remainder trusts, but you'll have your pick of dual schedules both days, and then you'll be able to get the recordings and materials on the programs you can't attend. It's a fantastic program. It's a great cause, Notre Dame University, and we've had a lot of clients buy the materials and really enjoy them as well. A special offer for you today, if you're watching this webinar or you sign up today, you can buy the EstateView software. It's a money back guarantee. So if you want a free trial, buy it, then we give you your money back. If you're not happy, I think within 30 days. And take a 10% discount. Just use the promo code 10PERCENT. And yeah, it's a 30-day money back guarantee. There's the instructions. And go ahead and get the Pro Plus. So that gives you everything we do. And then you can, if you want, within the 30 days, you could get your money back or scale down. But I haven't met anyone who scaled down yet. So before I go to the software, oh, and will slides be posted during the webinar or after? Yes, I will post the slides. I won't use the slides that much, but I will post them after the webinar, and I apologize that I did not post them before. Let me see if well, maybe I'll post them during, if I can figure out how. All right, so when is it time to do estate tax planning? Well, when you're an estate tax planner, it's always time. But when is it your time for your clients to get excited about estate tax planning? Well, probably now, with Vice President Harris starting to lead the polls here and seeing that the estate tax exemption may indeed go down to 1/2 of its otherwise applicable value on January 1st, 2026. And what does that mean? That means that the $13,610,000 exclusion that we now enjoy for our clients is approximately 1/2 temporary and 1/2 what we call the core. Remember, this was a $5 million exclusion that goes up with inflation, and it was temporarily doubled in the Tax Reform Act of 2017. They couldn't make it permanent because they couldn't balance the budget past 10 years. So the question is, when we come towards January 1st, 2026, is it going to stay at double or is it going to go to half? And if it does go to half, what is the use it or lose it proposition? And by use it or lose it proposition, I mean, if I give, say, 7 mil, let's say it goes to 14 million with inflation in 2025. I give 7 million in 2025. Then it goes to half in 2026. Do I still have my other 7 million? And the answer is no. You have to use up your whole core exclusion before you can get to the temporary. So for example, if I give away 7 million in 2026, and then I have a zero exemption in if I give away 7 million in 2025, then I have a zero exemption in 2026. If I give 10 million away in 2025, then I still have a zero exemption in 2026. So it's better for me to give 10 million away than 7 million away. And it's actually better to give the whole 14 million away if I'm really wealthy and if I'm sure I have that much exemption. But what if I'm not all that wealthy and I'm not sure I have all that exemption because I've done aggressive gifting, I've done aggressive sales, and how can I be sure whether I'm going to run out of assets? So we should talk about that for a few minutes. Now, if the client lost their spouse and got some portability allowance from the spouse, let's say the spouse died 5 years ago and there's a $10,000 portability allowance, the spouse didn't use their whole exemption. Now this person has a $24 million exemption. So they're going to have to give away the 10 million portability allowance plus the 7 core. That's a $17 million gift before they even start using the temporary exclusion. What the estate tax lawyers are going to have to start getting used to is the ability to implement a lifetime Q-tip trust so that you can essentially make the transfer that will be a 2026 gift to a lifetime qualified terminal interest property trust that will pay income to your spouse. And if you make that gift in 2025, you'll have until September 2026 to decide whether to elect to have that trust be what's called a marital deduction trust that then just empties back out to the spouse as if you never made the large gift, or whether it turns into a exempt trust that pays income to the surviving spouse but is considered to be a gift by you to that trust that will not be subject to estate tax in the wife's estate, even though she will get the income. That will give you until September of 2026 to decide whether that $14 million transfer is all or part gift or not. And if you're not sure how much exemption your client is going to have left, you can make a formula election, which would say, for example, I think I have a $14 million exemption. I make this election for the exempt trust to be the lesser of the 14 million exemption or whatever my remaining exemption is, and the rest will be in a marital deduction Q-tip that can empty out to my spouse. So I've gone way too quickly here for you to understand what I've just said, but for those of you who are tax professionals and those of you who are not, but you want to learn more about this, just let me know and I can send more information. Okay, so I also am giving you these slides, and I will make these slides available for you after the presentation. I'll email them to everybody. But Brandon and Jerry Hash, Professor Hash, have been working on all sorts of nice illustrations on what to do about the burn. So we'll be talking about the burn today. And what is the burn? It's not George Burns. He was a fantastic comedian, and he made it till what, 199? He was going to play the Palladium at 100, and he had to cancel. But comedians live a long time. That's why I'd like to be one someday. Anyway, when you set these trusts up and the grantor is paying the income tax on the trust income, the grantor can run out of assets. So we're going to talk about what to do with that. Also, before I go to the software, just a little bit of an update here, and that is that the applicable federal rate, which is the lowest rate that you can use on a family transaction, continues to hover, but for August it went down just a little bit. So you see in July of 2023, it was at 3.94% for a note of over 9 years. It reached a height of 4.73% in June, and now it's down to 4.47%. With a 3 to 9 year note, you can use 4.29%. With an under 3 year note or up to 3 year note, you can use 4.89%, and you can use the lowest of the last three. So for August sales, you're looking at a 4.47% interest rate. Now, if you go to the long-term applicable federal rate table, you'll see that this is the semi-annual rate. But for some reason, when you do an interest-only note, even though it's only owed annually, you have to use the semi-annual rate. And our software and many planners know that. The next thing I want to do is just show you what an installment sale looks like. This is what an installment sale looks like. So the clients have a $20 million investment portfolio or asset. They put it in an LLC, and initially they own 1% of the LLC as voting members and 99% as non-voting members, half by each spouse. And then they sell the 49.5% each non-voting member interests to trusts for the family. Client one sets up a spousal benefit trust, which pays the spouse whatever the spouse needs for health, education, maintenance, and Spouse two sets up a trust for the descendants. They value the 49.5% non-voting member interest at about $7 million. That assumes a 30% discount after conferring with a valuation expert. So spouse one makes a $700,000 gift to this trust, takes back a note at the applicable federal rate, which used to be 1.35% when we were doing this in the COVID years. And then spouse two does the same thing with a trust for the descendants. So what have we done here? We've reduced their estate from $20 million to $14 million as far as this LLC is concerned. That's helpful. Secondly, instead of their estate being based on growth on 20 million growing in the market, we're going to have their estate based on growth of 14 million based upon a fixed, fairly low rate of return of interest. And the third nice thing, which turns out to be the best sometimes, is that they will pay the income tax on all the income of this LLC, because these trusts are disregarded for federal income tax purposes. And therefore, when the trust is disregarded for federal income tax purposes, some really nice things happen. First of all, there's no income tax on the sale of the entity interest to the spousal benefit trust, because the spousal benefit trust doesn't exist for income tax purposes. Secondly, there's no interest income to the client on the annual interest payments that the client receives. In fact, there's no real tax return that needs to be filed for these two trusts. They can file an all-zero informational return telling the IRS that all the income and deductions from these assets are going on the client's personal Form 1040. Now, if the client dies during this process while the note is still owed, there might or might not be an income tax issue. I've never met anyone who filed an income tax return when somebody died with a note owed. If the client decides they don't want to pay the tax on the LLC income, they could cause the trust to start paying its own income. But if it owes the note at the time that you toggle off what we call grantor trust status, then there could be an income tax triggered. So you would want to pay the note off first. Otherwise, the client needs to understand that they're going to pay the income tax. Now, it's possible for the trust to have a provision that says that it would reimburse the grantor for the income tax. Now, what about when the client dies? Is there a stepped up income tax basis for these assets? And the answer, according to the IRS in Revenue Ruling 2023-2, is no. And most tax professionals who are aware of this issue and have studied it believe that there is not a step up. I personally believe that there's just as much chance as a step up as not a step up, and I have articles and references to prove my point, but most people disagree with me on many things. So what happens now with this installment sale 10 years later? Remember the rock band 10 years after? If you will send me within 2 minutes 3 songs by the rock band 10 years after without researching this on Google, then I will send you the book of your choice from my Amazon library. Okay. 10 years later, the LLC is worth 40 million. So what is the trust worth? Well, 49.5% of 40 million is about 20 million. It owes a note of 7 million. It's worth 13 million. 26 million is moved out of the estate tax system in a 10-year period. And remember, this trust can still be used for the other spouse. And if these trusts are in Nevada, they may be usable for both spouses. When you are worried about the burn causing loss of all of your client's assets because of the payment of the income tax, consider having some trusts set up in an asset protection jurisdiction where a trust protector could return the client to being a beneficiary of the trust if they ever ran out of assets. That makes good sense, right? So now I'll switch from the slides. And let me see how to do that. I'll move off the slides. And let's go. Oh, and let me see if I can now move the slides into the handout. I'm usually not so good at this stuff. I'll give it the try. Well, I guess it didn't work yet. All right, so now I will bring up EstateView, my pride and joy. This is, let me make sure you can see it. Yep, okay. So I went to EstateView.link, and if you're already a subscriber, you know it just opens up and this is what you see. And if you're not a subscriber, if you go to EstateView.link, then it will gladly take your money. Now I can also go to EstateView.info, and for some reason it's not reachable. Let's try it again. Maybe if I spell it right. EstateView.info. So this is free. And when you go to EstateView.info, you can click here to our EstateView video library, or click here to buy EstateView. if I click there to the video library, it takes me to, you guessed it, a video library. And then the video library, you can click on any of these calculators and it gives you a video of how to use the calculator. So if you're interested in how qualified personal residence trusts work, you can click on that video. If you're interested in how GRATs work or how a charitable remainder trust works, you can just click on those things, and we're quite proud of what it does. But I will go back now to estateview.link. And by the way, our pricing for multiple, the discounts for multiple units are there on the website also. So now, what would I like to do with EstateView? Well, let me just show you some neat things. What's going on in the news? I click on news there, and it shows me 4 different news sources at the same time. It can be with or without summaries, and I can choose my 4 sources. So now when I check news, instead of just going to Google News or Tax Advisor News or Bloomberg Wealth News, I see all 4 at the same time, and I can just scroll there. And then you've got a little across the bottom, what's called a ticker tape. If I have any questions about the software, I can click on chat, and then you see the different people who are giving us information, giving us questions, and that we're answering the questions. We're answering the questions pretty quickly, usually within 5 to 10 minutes, because there's 4 people in our law firm who are monitoring this for EstateView. Okay, so then I go back to the main screen, and I see the comprehensive plans in the first column, and then we have the calculators. Now, if you're like me, and for the last 20 to 25 years, you've been using one of the well-respected calculators, and I won't say their name, but they're good calculators. I won't mention that they include Larry Katzenstein's Tiger Tables, Vince's Number Cruncher, and Britmark. They're all really good. We've aspired to provide the same thing that they provide. And by the way, we own 2 of them and will continue to use 2 of them. But we've tried to provide more things that come along with them. For example, if I want to do a qualified personal residence trust, which I plan to show you, in our standard mode, which generally does what the other calculators do, I can have a person, and she might be 70 years old, and she might want to do a qualified personal residence trust, which allows her to live in her home without paying rent for 10 years. The value of her home, $2 million. We think the home will grow at 3.75% a year. And we'd like to know what the result is. If she transfers the home into this trust and she gets to use it for 10 years, it's not a $2 million gift. When I click to see the results, I see that the gift is $882,000. And then if she lives the 10 years, the whole house will be out of her estate. If it's worth $3 million when she dies, then you've gotten $3 million out of her estate based upon an $882,000 use of her exemption. So that would be the first one. Now, what we're able to do, and you have a little bit of some warnings below and some information which helps younger professionals and laymen understand what we're doing. And the next thing that you can do, and I'm just in the standard mode, which is $195, I think, or $199 minus your discount. So, but she'd like to see another one. What if she just goes 7 years? She may not live the 10. If you die during the Cupert term, it all gets unwound as if you never did it. So here I can click duplicate, and then I can change 10 years, let's say, to 7 years. So then I can say 10 versus 7, and my gift went from 882 to 1,165,000. So I could run another one. I could run a third one at 5 years. Now what I could do is 3 Cuperts, one 10-year Cupert, a 7-year Cupert, and a 5-year Cupert to hedge my bets, put 1/3 of the house into each Cupert, and then I can take a discount on value. But so that's what the standard mode can do. Now, the other thing the standard mode does is you can see here probability of survival chart, property interest value over time, and what proportion is out of your estate for tax purposes. And as you click up the year, this, let me go to Cupert 1 here. As you click up and down the year, you see the lower the year, the less the value of the gift, but the higher the chance of surviving that term. So that's kind of neat. But now I'm going to go to Pro mode. So with Pro mode, and this is what the other calculators also don't have, is I have a spreadsheet here showing every year of the Cupert and the tax savings. So now I'm actually showing the results of the Cupert, including the value of the property going up at the rate you chose. And then I can export the Excel spreadsheet to show the client what Cupert 1 looks like, what Cupert 2 looks like, and what Cupert 3 looks like. And then again, I have my charts and all that stuff. The other thing that I can do is I can show in the Pro Plus mode the effect of the rent being paid after the Cupert term. So after the Cupert term of however many years the Cupert term is, in this situation, a 6-year Cupert, she starts paying rent to the Cupert, let's say based upon 7% of the value, and then the rent money is invested at a 7% rate of return. She's going to pay the income tax on that growth within the portfolio. So what's that look like? Well, now your tax savings are significantly more because you have not only the value of the home out of the estate, but you have the rental amount out of the estate. So that's quite a large additional savings, and you have the estate savings from the burn. So the total savings can be significant. But then you have to ask, what if this person dies after the possessory term and there's no step up in income tax basis because of the IRS's position that you don't get a step up? So here I can click on show income tax result, and assuming that this tax basis of the home is $1,250,000, or I can push it up and down, and a capital gains rate of 23.8%. Now I'm showing my estate tax savings. Let's say if she dies at age 90 at $2,500,000, my capital gains tax at $458,000, and my total estate tax savings less capital gains, I'm ahead $2 million. So that's how the math can work. And now what I'd like to do, and this is what almost all of our calculators can do, is I can show the client the 3 different Cuperts with the information. I can get a general explanation of Cuperts, a short explanation of each Cupert, a planner's checklist, and a PowerPoint presentation. And then I can click on submit. And now it's preparing these items. So I've got a Word checklist, a Word general explanation, and there is my first PowerPoint. So my PowerPoint comes up and I can customize it, but this shows how a qualified personal residence trust works. Let me click on enable editing. It shows a 6-year Cupert. She has an 86% chance of survival 6 years based on the standard tables. This shows that she's going to live in it rent-free, no gift after the first year. And this shows the amount passing estate tax-free after 6 years would be $2,004,000. Estate tax savings at a 40% bracket, $490,000. More information about the Cupert, and then there's your inputs that we used. There's a nice graphic, and there's a summary of your numbers, and there's your Excel spreadsheet. So I'll go ahead and send this to everybody so that you can see it. And then there's my short explanation of each of the 3 Cuperts. So if you're serious about doing estate tax planning and making sure you get the numbers right and showing the client the numbers, then that's a good way to do it. Now, I'm going to move now to a comprehensive plan for an unmarried individual, also known as a single client. So to give you the graphic here, you have Bob Sample. He has a $3 million home, $29.5 million of investments. He's adding $325,000 a year to his investments. In fact, years 1 through 19, he's adding $325,000 a year, and then he's going to spend $50,000 a year. So he's going to spend more than he earns as far as what he's adding to the portfolio. So his investment return 7% minus 0.4% in investment costs and a 2% of portfolio per year income tax. And at the end of year 1, he'll have a $19 million estate and an $8 million estate tax. Now, to get into a little bit more detail on the inputs, I'm going to click over here to the left, and on the left, you have all the inputs. But if you want the inputs to be bigger, you click where I'm clicking, and you see, do I want to show a Cupert? Do I want to show annual gifting, discounted annual gifting? Do I want to show life insurance before and after a life insurance trust? Would I like to show a large gift? Would I like to show an installment sale? And would I like to show testamentary charity? So there's his name. I've got him at age 60. He's a tobacco user. So we see his life expectancy is to 2040. Let's say he's not a tobacco user, and let's say he's going to live 25 years. So I'll get him to 2049. That'll get him to 85 years. He's never used any of his exemption. There's his savings rate. Let's move his savings rate down a little bit. And let's say he's only going to be saving till he's 70. Then he's going to retire and start spending more. You could say he'll start spending $100,000 a year in excess of his pension and Social Security. And then, did he leave a spouse? Does he have is he the beneficiary of a surviving spouse? Maybe the surviving spouse left him a $500,000 credit shelter trust that we can mention here. We can put in whether his surviving spouse left him a portability allowance, maybe just a little one. There's a portability allowance. Maybe she left him $1 million portability allowance. And then here's the big question. Is the exemption going to drop to half in 2026? Yes or no? I can show it one way with yes, another way with no. And then the estate tax rate, he's got 29.5 million in assets, growing, as I said, at about 7%, but minus a lot of taxes and a lot of costs. Let's go ahead and give him 7.73%, $3 million home, and he would do one Cupert, an 8-year Cupert, or he could do 2 Cuperts. No, he'll just do one. And then annual gifting, let's say he's got 2 children for the next 10 years, and then he figures after 10 years he'll have 4 offspring. The children will have children, he hopes. And then he may do discounted gifting. He may gift LLC interest with a 30% discount. So let's see where that takes me. I close that back up, and now I've still got my options there. All right, so where am I with this? So I'm showing death in year 1. Let me go back. Death in year 1, $7 million tax. Now, if no planning and a 25-year life expectancy, we see that when he dies in 25 years, 30 million becomes 110 million. The little credit shelter trust his wife left him, $1.8 million, and life insurance, his term life insurance will have expired. His estate tax, $39 million. So let me just turn that down there. All right. So now it's see, I still have my inputs on the left. If he wants to change anything, if he says, well, Alan, I think I'll spend more than 100,000 a year. I think I'll spend 275, 300,000 a year. Okay, fine. You still have a problem. Okay. So tell me what the qualified personal residence trust is expected to save me. Well, I'm not going to go into all the details I did with the calculator, but I am going to show you that if you do a qualified personal residence trust with your $3 million home, then in 25 years, the home will be worth $7.5 million out of your estate. And the rent and the growth on the rent will be $12 million. So that qualified personal residence trust can be a huge estate tax saver. In fact, the estate tax savings, it goes from 36 million without the Cupert to 29 million with the Cupert. So again, I can go over all the details with the first calculator and now show him the big picture. But he's not out of the weeds. He still has a $30 million estate tax issue. So now I'm going to say, well, you could do annual gifting, and you're probably doing annual gifting. So let's click here. And now the estate tax is down to 27 million. The gifting trust has 36 million in it. 36,000 initially, but gets up to 5 million. So that gets his estate tax down. So let's look at those gifts again. He's giving 18,000 per child for the first 10 years. So that's 180,000 for the first 10 years, and then 300, and then double that. And by the way, it's going up with inflation. So that's where you get to 5 million too. That's pretty good. The other thing it's doing, by the way, is it's reducing his investments every year by him paying the tax on the Cupert savings account and on the gifting trust account. So the next thing is, if he would, instead of gifting cash, gift LLC interest at a 30% discount. Now that gift trust is 7 million for, and the estate tax is 26 million. So that's where he is in a conventional situation. And when I click on timeline here, the timeline tells me that every year as he dies, you see that in blue, you see the nice little gift trust. In yellow, you see the qualified personal residence trust. And in red, you see that chunk that comes out of his estate as federal estate tax. So of course, going back to logistics, his question to you is, should I make a large gift? And I can go to the large gift calculator, click on large gift on the right-hand side. This is just part of this program. It's not the large gift calculator actually. And now I can go to my inputs on a large gift, which shows up on my left there. And I'm looking at a $13,610,000 gift and no discount. So 13.6 is the top it'll go, no discount. And that will zero out his estate tax. 13,610,000 gift brings his investments down to 15,890,000, still has the bypass trust, still has the life insurance. So he's in good shape here, isn't he? Well, let's go to the timeline. There's a little issue. And the little issue is that we were only looking at this at 2048 when he died. Yeah, 2049 when he died, there's no estate tax. But if he happens to die earlier, then there would be a federal estate tax. So he could also, by the way, gift more. So by taking a discount, for example, if he put 16,610,000 into an LLC and took a 30% valuation discount and made a 99% gift, calling that an 11,627,000 gift. Now the estate tax is smaller and skinnier, but look what happens there. He runs out of investments right there and has to start living on the $500,000 trust. So he may not want to do a gift this large. So why don't we scale back to a 7.6 million going into an LLC, and he's going to do a gift of 99% of that, valued at 5.3 million. And I want to show him another thing he can do called an installment sale. So I'll go back to logistics, and now I have him here with a $10 million expected estate tax. Now I want to show him an installment sale. So for now, I'm just going to turn off the gift completely. And with the installment sale, here's what I'm going to do. I'm going to put 20 million of his investments into an LLC, and he's going to make a gift of $1.4 million to an irrevocable trust, and then he's going to sell a 99% non-voting member interest in that LLC for a $14 million note at 4.47% interest, payable interest only for 20 years. And it's going to hold that portfolio, which is going to grow at the growth rate that we have indicated. So now I'm going to click on installment sale, and look what has happened. Before the installment sale, I'm looking at a $26 million estate tax. After the installment sale, I'm looking at a $94,000 estate tax. And what's the reason for that? Well, in year one, I moved $7.4 million out of his estate by making only a relatively small gift, as I showed you, $1.4 million gift. But if you take away the discounts, I really moved 21,409,000 worth of assets out in exchange for a $14 million note. So now for 20 years, this trust is growing in value and he's paying more and more income tax as the result of that. So that trust has $67 million in it. And let's look at the timeline. There's the timeline. So you see that estate tax coming down gradually, very similar to the gifting. Now, he may or may not be comfortable with that. He may want to buy life insurance and do a life insurance trust. He may want to make part of that installment note what's called a self-canceling note, and you pay a higher interest rate and it cancels when he dies. We could do all of that. For example, we could change the note to self-canceling and then change the interest rate to the higher rate you would need to use for self-canceling. So that might be an answer for him. And also we could do a combination of the self-canceling note and the large gift. So we can click on the large gift of 7 million. And now the estate tax is much less, but he's going to run out of assets right there. So we're going to look at that. That's probably a good plan, especially because if he starts running out of assets, we can toggle off grantor trust status and have the trust start paying its own taxes, say in year 5. And that's the view that we're going to get. Now, finally, another number that we like to run and show clients is, what about charity? And the client says, well, what about charity? Well, did you know that on your death, you could leave assets to a charitable lead annuity trust, which would pay charity an annual payment, could be a family foundation that your children control or a donor advised fund that your children control for charity. And then after the 20th year, whatever's left in it, using our smoke and mirrors, legitimate planning techniques, will go to your children estate tax-free. In fact, if you're lucky, 50% will go to charity and 50% will go to the children. Or more conservative, 60% to charity, 40% to the children. So I can go back to logistics and show this to you. Actually, I'll go to timeline. So now when I click on testamentary charity, this shows that instead of an estate tax, more will go to charity. And let me turn off the large gift. When I turn off the large gift and go to logistics, you see with the installment sale alone, he would have had a $7 million estate tax. But with the charitable lead annuity trust, now you have no estate tax. The children, instead of receiving $103 million, only receive 91 million. The charitable lead annuity trust gets 19 million. But at the end of the day, the kids get another 7 million 20 years later. So, it's a balancing act here. It's important to explain to the client, what these techniques are going to do and what the flexibility of the techniques are. And now I can generate a client letter. So I click on generate client letter. I can select all my scenarios. I don't have to show life insurance, and I can show all these details. And then I click on generate client letter. And now it is writing a letter. There's all these squirrels in India, and they're all writing this letter. Each of them writes a separate part of the letter until the letter's written, just like an old Bugs Bunny cartoon. And you see it writing the letter across the bottom there. By the way, this program works on your iPad and your PC and all that stuff. So there's my letter. It's a Word document. I can enable editing, and I will send this to everybody as well. And this explains the estate tax system to a non-married individual, gives you all the inputs that we chose, and then gives you the chart, no planning, with explanation and some numbers, and then with planning each different scenario. So that works very nicely to have all those things there for you. And it will also, if I click here, it will create the PowerPoint. So I would have all these charts on PowerPoint. And then for all of our calculators, we also have share with client. So now I've done this, I could do a Zoom video, which I commonly do, and then it gives me a code. I click on URL and then copy to clipboard. Now all I have to do is start an email to the client and hit paste. It will give the client this address. I tell the client to use code 313276. I can send this to the client, the financial advisor, the tax lawyer, the psychic, the hairdresser, and then they can all use this calculator for up to 2 weeks. So it's nice to be able to share this. A lot of the clients, do enjoy using these. And then I can run a second one with the exemption not coming down. So if the exemption doesn't come down, what does this planning do for the person? If I go to no planning 25 years, there's still a serious estate tax with the exemption not coming down. And after the installment sale, there's still somewhat of an estate tax. But you can run the numbers and then you can print another letter. And of course, if you're married, and that may be a strategy, go ahead and get married to somebody who has a big exemption and have them die before you, so that you can get their portability allowance. That's a great advice to elderly people in nursing homes. Find someone else there who doesn't have any children, who doesn't have much of an estate, marry them, have them die first, and get their portability allowance. Okay, so that shows you that calculator. I can go back to another calculator here. Let's see. Would you like to see a large gift calculator? Because the large gift calculator, and let me just go back home. The large gift calculator is going to be very important for 2026 planning. So here I've got a 70-year-old expected to live to 85. Saving $200,000 a year for the next 10 years. And let's be more realistic here. Let's go to age 60 and saving, she's gonna survive to age 85. She's gonna save $200,000 a year for the next 10 years and then start spending $200,000 a year. And after another 10 years, she's gonna slow down her spending to $100,000 a year. That's important to show. She's got a $750,000 home, 25 million of investments, growing at 7.5%. Her tax rate is 2%. She plans to pay all the income tax on the trust income, and she'll start off with a $1 million gift with no discounts. So I click on results, and here I see her basic information across the top. And what it shows me is that her estate tax savings from that $1 million gift is $2,039,000. So that's not a bad day, certainly worth doing. And then I can show her a logistical chart which says no planning, 31 million estate tax, with planning, 29 million estate tax. The gift trust will have $6 million in it by the time you die in 25 years, and your estate will be smaller because you'll be paying the income tax. So she says, that sounds good. What else can you show me? What should I do here? So I can say, well, make a larger gift, of course. So I can duplicate the gift number one. Now I have gift number two, and I can say, let me show you a $7 million gift. Now, by the way, the whole time it's keeping these spreadsheets. So the first spreadsheet is showing me her core exemption, which we talked about, and showing me her temporary exemption, which we talked about, and her total exemption. And I've set this for the exemption to go to half. On her $1 million gift, she's only using $1 million of her core exemption. She's never touching her temporary exemption. And then here's her estate tax savings each year. You see the estate tax savings from the burn is going to be $1,134,000. So that's pretty significant. The total estate tax savings, $2,039,000. So you see that on the spreadsheet. If you want to see every other year, you just click there. You see every other year. If you want to export the spreadsheet, you click Export Spreadsheet. But now with my $7 million gift, which is number two, you see she's used that whole core exemption, but only a tiny bit of the temporary exemption. So the savings here is going to be more. It's a $14 million estate tax savings. The savings per million gifted incrementally is a little bit better. And one thing Jerry Hesh had me ask is, how much will she have left at age 100? And at age 100, she'll still have $75 million left. So she should be pretty secure. And then I can show her what this looks like, both logistically, like I just showed you, but then we can also show it by timeline. So by timeline, gift one, a lot of estate tax, not much in the gift trust. But then the $7 million gift, gift two, less estate tax and more in the gift trust. But let's go back now and do a larger gift. So what I'd like to show her, just to educate her, is if I can just get another million out of her to go to 8 million, now, because I'm using more of, that I'm past the core into the temporary, that next million saves 2 million for of taxes. So that we want to get into that core as much as we can, and she'll still have $57 million left at age 100. So let's do another one. And let's show her a maximum gift, $13,610,000. And what happened there? You saw that turn red? If I gift $10,610,000, she's going to run out of assets. She will not run out of assets. But if I gift $11,610,000, she will run out of assets before age 100. Now that assumes that she'll pay all the tax, but let's see what that looks like, because I want to warn her that this is gift number 4, and she can, as I said, run out of assets. So there's things that she can do about that we can talk about. One of the things she can do is use discounts. So instead of, we can go ahead with the 306, put 13,610,000 into an LLC, take a conservative 30% discount or even a 25% discount, and I'm on gift number 4 here, and she's going to run out of assets in a bigger way if we put more away. But going to the timeline for number 4, what we can do to increase is to decrease the, I'm going to show all 100 years. So I'm going to illustrate all 100 years. So now I'm illustrating to year 100, and you see her running out of assets at age 92. And that is a concern to her. Now, maybe this is a Nevada trust, or part of it is in a Nevada trust that she can be added back to. Or how about if I'm simply going to toggle off grantor trust status in a particular year? So when would I need to toggle off grantor trust status for her to not run out of assets? How about, I don't really need to worry about this. If she's going to make it to 100, I don't have to toggle off grantor trust status until year 30. So I definitely want to be able to toggle off grantor trust status. Now you may get into dire situations. Let's say she only has 20 million of assets, but she still wants to do this gifting because she really wants to get down the estate tax, but she would run out of assets in 2045. So I can toggle off grantor trust status at an earlier year, or I could also use a private annuity sale of her assets in exchange for a lifetime annual payment that may begin at some time in the future, and that may that may help the situation. Or I may use what's called an installment sale, so a self-canceling installment note. So I've gotten into the weeds here a little bit in running the numbers for her to show her her choices. And there's other things, of course, that we can show her. We can go to general explanation, show the PowerPoint for her so that she sees these PowerPoints and can remember them, and then hopefully help her make a decision before the end of 2025, if not sooner. I mean, why not do the $1 million this year or the 7 million this year, whatever she's comfortable with? So you've got everything lined up, and she doesn't have as much anxiety and as much to learn when you decide how much to top it off with when the time comes. So I see I'm over my time and have very much appreciated the opportunity to share the software with you. The software does some other cool stuff. If you want to hang on just a minute for me to explain that the Nest retirement calculator allows you to put the client's financial information into a spreadsheet so that the client can see, well, as I'm heading now, I will be able to retire. I'll have this much more than I think I need to retire. But if I change some assumptions, such as I don't want to live on 175 a year, I want to be able to live on 400 a year. Well, now you got an issue. You're not going to be able to retire on 400 a year unless you start saving more. In fact, you'll have to start saving an extra 172,000 a year. So, and then this gives you a spreadsheet with a column for every single important thing. So, okay, you want to give 10,000 a year to the church? There's the column. You're going to pay for a wedding? There's the column. You're going to buy a bigger house and get more debt? There's the column. Because everything in this module has repercussions. And then it shows net worth over time, how much your children can expect to inherit. So that's the Nest retirement calculator. Then the RMD calculator, very popular. We do this for every client who comes in the office. We just say, okay, here's your age. Here's what you might live to. Here's a rate of return. Here's how much you have in your IRAs and pensions. And let's take a look. And here's where you are with your pension going up in value. Here's your required minimum distribution. You can bunch the first two or not bunch the first two. And what's interesting is your IRA, even though you're taking these distributions, it continues to go up until age 95. And the distributions continue to go up until age 95. And then you can say, do you want to give to charity? Do you want to use the charitable qualified distribution, right, which is right now up to $105,000 a year. So you can allow for the charitable contribution to go up to or exceed the required minimum distribution amount once they reach 59 and a half. And we just show them this spreadsheet when they come in the office, and it gives them a sense of financial security. Another thing we have, which is very rudimentary but still fun to use, is a Monte Carlo simulator. So if they're going to have 35% bonds, 65% equities, 25-year period of time, you can see that 1% of the time or less, they are going to be expected to have a 4.27% rate of return. 1% of the time or more, they're going to have a 13% rate of return, the average 9.11. So we can't just say 7% rate of return. Maybe we should be showing them the lower 10% of 6.45 and the higher 10% of 11.72. But this is also a good way to explain why we think they should have more bonds, more equities and less bonds, because when you run a Monte Carlo analysis based upon the history of the stock market in the United States, you see that if you have more in equities, you're expected to have a higher rate of return. So here, 30% bonds, 70% equities versus 35-65, you see the rates of return are expected to be higher, and it's safer from inflation. Now, I'm not an investment advisor, and I've probably not chosen a good example here, but at least it's something that you can use to show the client, and then they can compare and see this is a big variation. We can't promise you a 7% rate of return. We should run your estate tax planning numbers at higher and lower percentages to take this into account. So also, what about life expectancy? Something interesting about life expectancy is that when you have two people, let's say ages 63 and 66, and I want to look at the results, the life expectancy of the 63-year-old is 20.6 years. The life expectancy of the 66-year-old is 18.3 years. But there's a 50% chance that at least one of them will be living when the estate tax is due in 24.7. So I used to run my numbers to age to 20 years or 22 years, but now I'm running them to 25 years. And these are the standard life expectancy tables. Another thing we do for you is life insurance estimator. So I've got this client who's age 68. I don't sell life insurance, by the way, but when he's coming in the office, I'd like to know what it might cost to get him $1 million of life insurance, so we can talk about whether he can afford it, whether it might be a fit for him. So I see standard term coverage rates, and I see preferred coverage rates, and I see a universal for life rate. And I have a ringing phone here. Let me stop the phone. So that's the life insurance module. We're going to be, of course, improving all of these modules, but just wanted you to be aware of them. And then one of the fun ones that I'm really happy is coming along, and this will be the final one I show you, is the letter writer. So with the letter writer, I'm reminded of what I may want to include in a letter that I'm writing to a married couple about their estate plan. And do I want to introduce the letter? Of course. Do I want to talk about confidentiality and the attorney-client privilege? Maybe I do. Do I want to talk about the CPA privilege to explain to them how that might work? I might. Do I have a conflict of interest situation that I need to talk about relating to the marital situation? Should I recommend separate separate legal counsel for each spouse? Do I need to tell my billing department who the client is to make sure that the bill doesn't show the wrong people? Do I have a joint representation issue that I should address? If I'm doing an installment sale or a family LLC or limited partnership, what are my business purposes? I've got all of John Porter's business purposes here to put into the letter to explain to the stockbroker and the investment advisor all these business purposes, which can be important evidence if the IRS wants to see that it's a bona fide arrangement. Which one of all of these things am I using or not using? Then do I want to talk to them about an installment sale? Do I want to mention fraudulent transfer risks? Do I want to refer them to one of a number of different individuals or advisors? Do I want to refer them to a subspecialist attorney who does securities law? And then do I want to talk to them about their real estate? Do I want to talk about deeds? Do I want to mention zoning? Do I want to mention that they should get a survey or we don't have a survey? Do I want to ask them for copies of life insurance policies? Do I want to talk to them about life insurance policies? So you check the boxes. Do I want to become their registered agent? How am I going to bill them? And then once I've checked all the boxes, I've seen the letter there, but I can now create the letter, and the letter downloads as a Word document. And then I can, of course, edit it, but at least it gives me a start on this nice letter to the client and a nice checklist. So that is what I was going to show you today. I'm going to take special care to email all the participants the PowerPoint slides and the other information. Oops, wrong PowerPoint. What did I do? Where is it? But anyway, let me see if I have any questions here. Okay, what kind of legal fees are generated by this type of planning? Savings of tens of millions certainly has a nice ring to the client. Well, we charge hourly. So the legal fees for one of these large estate plans could be anywhere from $10,000 to $35,000, depending upon how organized the client is and whether they have another plan that you're cleaning up, etc. But the cost of the plan is small compared to the savings if you do it right. Okay, Jeffrey, do you find using a 7 to 8% annual growth rate as a realistic projection from a historical rate of return? Yeah, 7% is a nice growth rate. 7.2% is nice because that would double the assets every year. And that's pretty much what my growth rate has been in our conservative portfolio since 1999. So I think anywhere from 6 to 8 is what the financial advisors are telling me is appropriate. Monte Carlo, you like? Good. All right. Well, and then again, how do I buy this stuff? If you would dare to buy it, we can go back to EstateView.info, and then you can click there to purchase EstateView. If you need if you're buying it today and you attended this webinar and you need that discount code for the 10% discount, just send me an email and I'll be glad to send it to you, because I think my PowerPoint somehow disappeared here. So thanks again, and really appreciate the opportunity to present. Some of you are subscribers, some of you are friends, some of you are new to us, and what we try to do is talk about things that are interesting and help people as much as we can. Thank you to Professor Jerry Hash, Bob Keebler, Jonathan Blotmacher, our full-time programmer, Kevin Gray, and my family and law firm for putting up with all this. Have a fantastic rest of your day, and I hope you use this to help others. Thank you.